This is the Authority Company podcast, conversations with leaders who are building the future. Hola, I'm Joe Pardavila, and my guest today is Tyrone Johnson, a veteran CEO, private equity operating partner, and author of the new book, Beyond the Deal, A CEO's Guide to Private Equity Success. After more than 25 years leading companies through acquisitions, transformation, rapid growth, and exits, Ty's going to share the emotional, operational, and leadership realities most founders never see coming after signing a private equity deal. We're going beyond finance to explore identity, ego, pressure, culture, and what it actually takes to survive and thrive once the real work begins. Tyrone, welcome to the show. How are you, sir?
Doing well, Joe. How you doing?
Excellent. Thank you for asking. And so I think we need to start this conversation by addressing the big giant pink elephant in the room, and that's private equity. Because as you know, Tyrone, outside of private equity circles, there is a bit of people look at it with a crooked eye, like, private equity. That means they're coming in and they're going to buy it and they're going to break it up and then they're going to sell it into pieces. And there's so there's a negative connotation that is associated with private equity. Yeah, judging by your facial reaction, I feel like you've heard this before.
I have. I think it's a common misperception. Not to say every deal works out the way everybody wants it to,
Right.
but in my personal experience, there's been far more upside than downside being part of private equity, and hopefully, the book is able to give people a little bit of a indication as to how to go about having maybe one of those positive outcomes. Frankly.
Yeah, and so tell me about the well, I want this to be a very positive conversation, but I want to get the negatives out of the way.
Right.
Where do those negatives come from? Are they founded in reality? Is it one of those things where, like, I've spoken to people who are in the auto industry, and they're, for many years, Tyron, as you know, like car salesmen were seen as sleazy, and
Right.
maybe it's one bad apple out of 100 that's bad, but the whole industry gets kind of like tarnished because of one bad apple. Tell me why this negative sort of vibe when people discuss PE.
I think it's for primarily two reasons, possibly more. Number one,
Okay.
private equity folks do use leverage or debt to help finance the companies and help to support growth, right? So they will go out and borrow money on behalf of the portfolio companies, and that ends up on the balance sheet, right? And to the extent that the company gets into a tough situation, right? Maybe the economy changes or maybe there's poor execution, there may be trouble servicing that debt, right? So,
Right.
so that's kind of one, I think, reason people say that, and that does happen, right? But that happens to all companies and not just private equity backed companies, right? But then also, private equity's goal is to come in and try to improve an operation, and oftentimes that means finding ways to be more productive, more efficient, gain throughput, execute at a higher rate, a faster pace, and that might lead to layoffs, right? That might lead to changes that make people uncomfortable. But the goal is to create value for the investors, and sometimes that value is created by virtue of taking, cost out that frankly isn't contributing to the growth of the business.
Got it. Oh, that's good. That's a great breakdown. Well done. I feel like you've explained that before, so I appreciate you
Right.
taking the time to do that. And it is funny too, in terms of the M&A world. Like I don't know if it's just me or it's like they call it the Bader-Meinhof syndrome, where if you're aware of it, you see it all the time. But like anytime there's a merger acquisition about to happen, for me, this could just be me just because I'm so used to seeing it, is that a majority of the M&A is going to be private equity. It's not going to be a larger company swallowing up a smaller company, as we've seen over the course of our lives over the last 30, 40 years. Is that true? Is it more acquisitions are happening from the PE space than they were from a traditional large company buying a small company?
I think that's probably true because there are literally thousands of private equity firms out there now, and one strategy that private equity folks use quite successfully is called a buy and build strategy, where you buy a platform company usually, so one individual company that has strong bones, right, strong foundations, maybe really good management, and you utilize that infrastructure to go out and buy smaller businesses and bolt them on and attach them, and you'll see that happening in certain spaces. We call it consolidation now. It used to be called roll-ups, but it is not unusual at all for private equity firms to utilize that approach to scaling the business. And frankly, when you look at the makeup of many private equity firms, they're former investment bankers who spent their early careers doing M&A work. So
Right.
it's pretty natural for them to come in and leverage their experience. And then when you look at the management teams, right? Many of us have the same experiences. So you put that together and there's a lot of value that can be created. So it's probably not something that you're imagining is happening more often in private equity. It's probably the case that it is.
Oh, awesome. Good stuff. All right, so Tyrone, I want to ask about something you write in the book that you say that founders sometimes think the closing of the deal is the finish line. And I know for and anyone who watches the stuff I do, stuff I write, I talk about this check the box mentality, and it's sort of like you going through the motions, you're going and people don't think about leaders checking the box. But in your world that you talk about it in the book is the idea that sometimes founders, when they're being acquired, they are checking the box and they're like, and checking out. Tell me what happens when they realize that that's really just not the end, but that almost the beginning of a new part of their life.
Yeah, so it's a really important element of what I try to communicate to the readers, right? Sometimes the process of getting to the close can take 6 months, 9 months, in some cases over a year, and it's exhausting. And when you finally get to the point, you feel like you got to the finish line, and if you're a founder, you probably received a nice payout, and you
Right.
feel like, okay, all the hard work is behind me, and I can just get on with running the business again. Should the founder stay, right? And it couldn't be further from the truth, Joe. This is when the work really starts because there's probably a thesis associated with why that private equity firm purchased that business, and they're wanting to implement the playbook, right? To scale the business and to scale it profitably, which is going to come with changes and situations that I'm certain that founder has never found himself or herself in before. And the change and the pace of change associated with it can be startling and difficult to accept.
Yeah. And so your experience, you were both an operator and PE partner. When did you realize that those two worlds see leadership completely differently?
Well, yeah. So, speaking as an operator, there are tendencies to have biases, right, around the people that have worked alongside you for many years. In small founder led businesses, it's often the case that family members are part of the business, right? So
Right.
trust has been developed over years, and frankly, there's a likability, right? We're comfortable. A lot of people talk about a family oriented business. So that's a tough dynamic to change when it becomes clear to a private equity operating partner or investor that maybe people on that team don't quite have the capability that they need for what's next. And that
Right.
can become awkward, right? That can become challenging, but the change has to happen in order for the business to achieve its desired results. And that's a part of the discussion that typically doesn't take place pre-close, right? It's a very romantic, kind of situation pre-close. Everyone's selling to each other, right? We're going to be great together. Your business is fantastic. Can't wait till we, are able to, grow this and do that. The reality is you're probably not in either case being completely honest, right? It's kind of that deal fever that people talk about,
Right.
but then when that's over and everyone kind of, sobers to the reality of now we have to really get stuff done, changes are going to need to be made in most cases. And many of those changes involve personnel, people that operators work close to, maybe the leader of the business, him or herself. And that becomes quite challenging for an organization culturally, right? Because then, Joe, people start to question what that means for them. Well, if Ty's running the company and the private equity firm asks me to leave, they don't feel like I have the capability. Or let's say I opt out, right? This isn't for me.
Sure.
Well, there's potentially hundreds and maybe thousands of employees in that organization that start to ask that same question. Well, what does this mean for me? Do I still have a role? What are the expectations? Maybe there's self doubt. Can I run at the pace that these folks want me to run at? So it's really important to figure that out as early as possible and establish what it is you're trying to accomplish and get the right team members on the train, so to speak.
It's good stuff. It's funny, Tyrone. You talk about deal fever, and I've seen this in multiple occasions where the folks that are involved in the actual transaction are almost. and it's a business cliche. They're working the deal from a 30,000-foot view. They're looking at as, here are the big numbers, here's what's gonna cost, here are the people affected. And then when the deal happens, the people below that have to deal with it are like, would say something comes up like, "Wait, this didn't come up at all during the conversation?" Like, "Oh, no, this never came up." And you see it over and over again when these acquisitions happen where there are things that are super obvious that maybe should be discussed during the acquisition, but they're kinda pushed aside because the people at the top don't believe it. How do you prevent that kind of stuff from happening? Because I feel like it happens almost all the time when you see some sort of acquisition where there are important bullet points that probably were missed or kind of pushed aside because it wasn't important during that deal and the deal fever that was happening. How do you prevent that kind of stuff from happening?
I think it all comes down to the quality of your due diligence, right? How deep you dive into that organization pre-close. What I tend to do is obviously spend time with the seller, the founder, but it's equally, maybe even more important, Joe, to dive deep into that organization and meet the middle management team
Mm,
and really assess what it is, determine whether or not what you're asking them to do, they have the capability to do, and if they have the desire to do it.
Now, how often does that happen though, Tyrone? Because I'm thinking, like, I rarely hear middle managers involved
Yeah,
in an
well,
M&A.
it's tough, right? Because in some cases it's confidential and you can't reveal until a certain point in
True.
time that a deal is happening, right? And deals fall apart, as you know, Joe, things happen. So it's tricky because in some cases you can't reach out to them. But when you can, if it's a large deal, even if it's a public deal, you do have the opportunity to really take a deep dive and start to meet the people who actually do the real work. And as a CEO, and again, I'm not, casting aspersions. I mean, the real
Sure.
work is done by the middle management team, the people in the business, the people dealing with customers and suppliers and employee issues every single day, every hour. That's what makes the business work, truly. And understanding their challenges, right? And then even explaining to them what it is you hope to accomplish by virtue of the acquisition is super important. And they start to feel like a part of it, right? And you'll hear this from a lot of deal people. When you start to get into discussions during the integration or maybe even close to the close, and the company being acquired starts to use the word we, right? Instead of you or they, you've got a little bit of buy-in, right? Because now they're talking in the context of what we can all accomplish together. And that's what we all try to, kind of endeavor to achieve. How can we get the mind share of the employees who are really on the front lines to buy into what we're trying to do? Now, in certain cases, Joe, the CEO or the founder, they don't want you talking to anyone else.
Right.
They're very controlling. So your point is valid. It's tricky, and then in some cases, maybe the owner of the company isn't close enough to the details to answer the question one way or another.
Right.
So
Or
they'll
should be. They probably shouldn't be either,
right.
but
So sometimes you're just not going to know until
yeah.
you get to the other side of it. But once you do get to the other side of it, you've got to take a deep dive and you've got to understand what you have and make the changes as quickly as possible. Should changes be necessary?
How important is it for you to mention to the founder of like, "Hey, listen, we get that this is your baby, but you've gotta let us into your family." Like, because like you said, maybe they either don't know, don't wanna know, or for they're being more defensive than anything, like, "Hey, listen, before we close the deal, I'm not letting you into this house." But how important is it for the founder to then ensure a more seamless transition, in the back end when they finally walk away?
Yeah, look, I think that's a great question. Different deal teams approach that different ways. Some people are super sensitive to the founder. They don't want to upset them. They don't want to risk the deal by being a little bit pushy or asking too many questions too early. That's not my style, Joe. I kind of get in there and I try to be very transparent. And I say, look, we really need to know this, or we're really going to need to meet so and so, and here's why. Right. In order for us to properly evaluate not just whether or not we want to do the deal, because there's probably real reasons we want to do it, but in terms of how we're going to grow it together. And let's say it's a turnaround. Let's say it's something that we all understand and admit isn't performing at the level it should. We need to understand what levers need to be pulled in order to change the trajectory. And that can't happen unless you're able to really talk to everyone and ask really tough questions and take a deep dive and try to gain some level of buy-in from the people as to what the plan needs to be on the other side of this, because no one wants strangers, right? People unfamiliar to just come in one day and say, Joe, you and your team, this is what we're doing from now on. And people
Right.
are like, well, that may make sense, but it would have been nice if you asked us our opinion, or maybe got a little bit of context from us. We have been doing this for a while, and so I think it's really important to try, to the extent it's reasonable and possible, to develop relationships and meet and get information outside of just that selling, kind of founder.
Excellent. One more thing on founders. I want to get into the founder psychology, this idea of their founders tie their identity to controlling a company. And when they're the founders, they're literally giving birth to a company.
That's right.
What happens psychologically when somebody wakes up and realizes they're no longer the final decision maker in the company that they built? When you've dealt with this in the past, like what kind of tips did you give people to get through this? Because again, many of these people have been doing it for decades. Some have been doing it for a few years, so it's not that big a deal. But when it's so tied into their identity, it almost seems like it's getting ripped their soul is being ripped out of them. How do you help them through that early going process?
So I think it's a really important question, because it's something we face all the time. If someone built a business and made it a great company and spent 30 or whatever number of years of their life, you know, associated with this company, it is their identity, full stop. And it is not unusual. In fact, Joe, it's common on the other side of deals for these founders to feel a little bit lost. Almost like they've been divorced, or maybe even a loved one has passed away. It is that level of visceral reaction to no longer being in control. So it's a really big deal. So to answer your question, what I try to do is create a future, to the extent that that person is staying, where they can continue to be contributory, where that legacy can live on, where we can take something really, really good and make it great together. So I guess the way I would position it is, well, look, it doesn't have to end here. There's another chapter, right? There's another evolution of this company that you're going to be a part of, and as proud as you are, we can make this an even more exciting opportunity for you and the people that work for you. But you've got to buy in, you've got to collaborate, you've got to be constructive, all the things. But to the extent that they've got the energy and the enthusiasm, it doesn't have to end there. Just because it's owned by XYZ Capital, right, doesn't mean, in terms of the consumers and the environment in which they trade, um, doesn't mean they know it's owned by private equity. It's often the case that companies you drive past every single day are owned by private equity firms, and you have no idea, because that local brand is what the consumers associate with, right? Not so and so capital, and not even like a corporate platform company, right? The roll up company, the holding company. Like, no one knows that name. It's a trade name, right? It's the local business that's always been in the community, and to the extent that that name is still there in the consumer's mind, that business is still being run by that owner or that group of people. So there's an opportunity for that legacy to continue. We just want to figure out a way to partner, bring to the table what we think is additive, utilize what you've done for years to make this a good business, put those things together, and we think there'd be a lot of success. And we talk in private equity, the second bite of the apple, right? And another opportunity for people to make a lot of money.
Wow, that's good. Just ballpark, what's the numbers in terms of like founders that stick around for like 5 years past acquisition? Is it relatively high, relatively low? I'm just trying to imagine. And again, this is all broad strokes, Tyrone. I know every founder is different, but generally, how many founders stick around that you see around after
Yeah,
these acquisitions?
in my experience, it's about 50-50, right?
Okay,
And so there are different reasons for each founder. Some founders are at that place in life, that stage in life, where they're interested in retirement and
sure.
kind of spending time with family, or going on adventures. They've worked really, really hard, and they want to decompress. We typically understand that going into the deal, so we're backfilling or doing whatever we need to do
Right.
to get the next leader in place. Some founders are super excited about partnering with private equity. They're like, I'm really good at this. You're really good at that. Let's combine forces and be great together. That's ideal. That's typically the situation I look for, frankly. And then there are situations where, despite best intentions, it just doesn't work out, right? Everyone had, good intentions going into the deal. Okay, we're going to do this together, and lo and behold, maybe the change that needed to be made was too significant for the founder. Maybe the pace was too fast. Could be a number of things, and then they decide that maybe this isn't for them. That's okay too. That happens. Or you could have the situation where it all goes according to plan, right?
Right.
Founder stays, he or she is energized, a great partner. Folks create a lot of value together. There's another wonderful exit. Everyone makes a lot of money. So all of those situations occur, but I would say founders probably stay half the time and leave the other half of the time.
Cool. Thank you. Thanks for humoring me on that. And I'm just wondering too, as you break that down, of the founders that stay, that 50%, what's their mindset? Like, are they still the boss? Do they think they're the boss? Or do they know like, "Hey, I'm not the buck stops here guy." How does that mindset kinda shift a little bit? Because like you said, they still have a leadership position, but that leadership position is not the one that's gonna be that rubber stamps, of maybe a large decision that needs to be made. How does that work?
Yeah, so absolutely. So intellectually, they all know, right? They're not the boss anymore. But emotionally, right? Like
Yeah, yeah.
in practice, right? It
Right.
can be a tough pill to swallow, right? Because there's ego involved here, right? If we're being honest, right?
Yeah, of course.
In their organization, the buck stopped with them, right? Any significant decision was their decision. Everyone went to them, and that sort of thing. Now they've got to, and I'm searching for words, but maybe I'll say humble themselves a little bit,
Yeah, sure, sure.
even in front of their organizations, and say, let me go talk to so and so about that. Let me
Mm,
ring the deal team or talk to the operating partner and get back to you. For some founders, they're fine with that, right? They're low ego. They understand it. They explain it to their team. Um, it's fine. It's not a big deal. Others, Joe, really struggle with it, and it's one of the reasons that I think of the percentage that stay on with good intentions, it ends up not working out because after some period of time, they come to the realization they can't let go of control, right? They have to be the alpha, right?
yeah,
Even if it is pretty clear with the benefit of data and other information, right, that a certain decision should be made. They may not want to make that decision because it's different than maybe something they would have done otherwise or they've always done. So it becomes a conflict, right? And ultimately, based upon the way the board is probably designed, they're not going to win that argument, right?
yeah.
They're probably not going to prevail in that situation, and that creates, I would say, confusion for the organization, but also distance from that founder. And what I've seen, and I wrote about this in the book, sometimes they quiet quit. They're here physically, right? They're
Yeah.
taking the check, they're showing up sometimes, but they're not engaged anymore, right? And it's clear they're deflated, right? And they're trying their best. So I don't begrudge founders because it's super tough, right? But at the end of the day, we have a responsibility for our stakeholders, our shareholders, our investors, our customers, our employees to run the business a certain way. And as a CEO or CFO and executive, you have a fiduciary responsibility, right? So you've got to figure out a way to get past that. And in many ways, in many instances, the way you get past that is you find someone else to take on that role.
Nice. All right. So we talked about the leader, the founder side of it. Let's get into the employee side because in the book you write, there's this great line that you say, equity exposes weak culture fast. Why?
Well, one of the reasons is private equity, by virtue of the structure, has to operate quickly. The way the capital structure is built, private equity funds obtain investments from what's called limited partners. And limited partners say, hey, for the investment that I'm going to make, I am looking for a return in a certain amount of time. Right.
Okay.
So this isn't a forever thing. It's not like a public company and they can give you their 10-year plan. That this doesn't work that way. The clock is ticking, right? And that doesn't mean there aren't things that can be done to continue to hold a company and that sort of thing. But by the nature of the structure of the deal, um, time is slipping, right? So
Mm.
it is important to expose it quickly. And it's why you have operating partners, and it's why you have deal teams, and it's why you have third parties come in to assess the company, because you want to make a determination as quickly as possible. What do I need to do to create value here? Oftentimes, Joe, that is done as part of the diligence, right? As part of the due diligence before you even close. You're making an assessment of what has to happen and maybe the sequence in which it has to happen. Many CEOs that come in, and that's another cohort group that comes into private equity, and not just founders, right? CEOs from other businesses or presidents come in for the first time, and they're coming in to accelerate change. You're buying, you hope, professional capability that can execute with speed and certainty, right? To go change the trajectory of whatever is going on. Um, I will tell you, and I say this in the book, the biggest challenge with, I think, corporate people coming into private equity and founders is the speed in which things have to happen. You will never have perfect data. You'll never have all the information and all the resources that you need or want, but you got to go. You have to act.
So let me
And
ask you that because I'm fascinated by this. You talk about the speed and this sort of like I feel like we're watching like a ticking clock movie or something like that, where the hero has to disarm the bomb, as right before the movie ends, right? And so why the and I know this may be a silly question, Darren. What's the rush? Like, why does it have to be done at a certain time? And again, this gets more to the nitty gritty of P&E that which people who are
that's
not
right.
initially don't understand. But what's the rush?
It goes back to what I said. So private equity firms need to return, all right, investment dollars back to their investors in a certain period of time if they hope to go back to those investors for additional funding, right? So
Okay, so
uh,
what's that period of time? Tell me what that
it
what
could it
general.
could be it's usually 5 to 7 years.
Okay, okay.
It's usually 5. So it's not a year. Don't get me
I
wrong.
was gonna say,
It's not like
you
a
made
hedge
it
fund,
sound
right?
like they got 6
But
months or
no, it's like
something.
5 to 7 years, right?
Right,
It's
okay,
to me, it's a sufficient amount of time,
okay,
typically, excluding any exogenous event, right? It's typically a significant enough amount of time to affect change, right?
okay,
So
got it.
that's really the window. Whereas, in a public company or a privately held company that's not private equity owned, it's not really that time oriented, right?
Yeah.
Obviously, public companies have quarterly earnings and that sort of thing, and the market determines based upon performance whether or not they should be invested in. But in private equity, it's private capital. They've already allocated the funds, so they're waiting for a decent return on their investment, and the general partners, the people that run the private equity firm, the partners of the firm, they're also investors, but they're likely going to want to go raise a future fund. And the way that you raise that future fund is off the performance of your previous funds, right? So if
Right.
you say, look, what I was able to return you in terms of the quantum, but also the time frame, that could, be what determines whether or not another fund is raised, or if a fund is raised, how much capital is raised.
Interesting, alright, good, thanks for the I feel like, I took a PE 101 class, if that's an actual thing, but
Mm,
I appreciate you breaking that down
Yeah,
for me. And
100%.
so, for a lot of people that are, selling companies, you mentioned the age aspect, but a lot of them, and also it's the capital aspect, like, they need this acquisition to happen for the growth of this company and scaling, and you've talked about how sometimes it doesn't work out, because the scale you're not able to scale for whatever reason. What is let's get into the reason. Why is it that so, say PE comes in, acquires a company, and the reason the founder does it is because they need to scale. What goes wrong that stops that company from scaling? Is it just the company wasn't meant to scale, didn't have the right people? Give me some general ideas as to why companies can't scale once they have these private equity dollars flowing in.
Yeah, it could be a litany of reasons, right? It
Yeah.
could be a change in the macroeconomic environment, right? A
Okay.
competitive dynamic can change, right? You made an assumption going into the deal that certain competitors would behave certain ways. It could be poor execution amongst the company. Had plans to go execute things. We're going to introduce a new product. We're going to enter a new market. We're going to, go into a new channel, and that execution is not done well, right? So they can fail for a lot of reasons. You'll see some businesses get hit by inflationary pressures, right? They modeled, or I don't know if folks know what I mean by that. They put together financial estimates
They
that,
project.
yeah, they
Yeah.
project that the cost of certain inputs would be, whatever. And, if you take the current state, the cost of oil being north of $100 a barrel, petroleum based companies, right? Companies that depend on that, byproduct for the production of their product, probably made assumptions last year, all right,
Right.
as to what that price was going to be, and built growth plans predicated on that. Well, that's probably upside down because things probably cost 2x now what they thought they were going to. And then you ask yourself, okay, how reasonable is it for me to be able to pass that on to the consumer? With so there might be some absorption by virtue of that company, and as a result, they can't meet their earnings, projections, and they have to pivot, or they have to slow down, or they have to, maybe reforecast when it is that they might be able to deliver the 2026 plan, right? Because things
Right.
have changed. So there could be any number of reasons that companies aren't able to deliver. What I try to do, Joe, is compartmentalize into what's controllable and what's not controllable, right? Because to the extent that something happens in the external environment, you can't really control it, but you do have to react to it. So you do have to, as a management team, go in there. So based upon this reality, what do we need to do? Right? What
Right.
can we do? And then you have to put a plan together. You have to explain that to your deal team and your board, and get buy-in, and then you go execute that plan. And everyone's typically pretty supportive of whatever has to happen in that particular situation. When it comes to operational execution misses, that's tougher, right? Because that would lead to, why should we believe that this team, who wasn't able to perform to plan, given all of the resources they needed and everything that they had to utilize to deliver the plan, why would we give them more capital? Why would we further invest in this team? What changes, Ty, as CEO, are you going to make to give us the confidence that your plan B, or your 2.0 plan, whatever it is going to be successful? Right. So now you've got a bit of a credibility issue, right? And remember, there's debt on the balance sheet, there's interest expense that has to be paid. Now folks are asking questions about cash flow and the ability to not only invest in the business, pay your bills, and do things for growth, but service that debt, right? And this goes back to an earlier question. So you start to ask, well, why does sometimes private equity get a bad rap? Well, think about a situation where a management team failed to execute a plan, and as a result, the cash wasn't covering the interest expense on the debt. And then you had to go back to your lenders and ask for some relief, and covenants were busted, and that sort of thing. That's a bad day, right?
Yeah.
And then to the extent that people hear about that, I guess narrative would be, oh, wow, see what private equity did, right?
Right.
Well, um, it's a little bit more complicated than that usually,
Sure.
you know.
So if a PE was facing that, whereas the company say it's that like that 5 to 7 year timeline, and it's operations that's doing it, is that when PE either does one of two things? They blow up the leadership team, or they just blow up the company? Like, what makes them decide, the nuclear option of blowing up the
Yeah,
company,
yeah, I
or the
think
less
blowing up a
nuclear?
company is the absolute last resort. That
Yeah.
means there's nothing else that you could possibly do to revive the thing, right? And that is
Okay.
that is truly the last resort. And when you see that happen, I think that's because every other possibility has been exhausted.
Got it.
But to your point, yeah, the first thing you're going to do is question whether or not you have the right team, right? If there's continual execution misses, there are going to be questions around the team, whether or not at the top or the middle management or a combination thereof, there needs to be changes, and it's why as operating partners sometimes they'll come in and take on an interim role, right? While maybe new leaders are being recruited. Some private equity firms create a dynamic where the operating partner is the person the CEO actually reports to, right? So that they've got a much closer, feel for what's going on in that company day to day. Because sometimes if you're not really close to this, it can just come out of nowhere, right? If you're not really close to the operation, and you're having board meetings every quarter, for example, you wake up one day and, oh my God, we're facing a crisis, right? So sometimes it's better to have people closer to the business, and that can create uncomfortability within the management team because they feel like they're being micromanaged or
Right.
spied on, or whatever the case may be, and I get that, but, you do really need to understand, why the performance isn't quite where you need it to be, so that, going back to what we talked about earlier, you can act quickly to resolve it.
Excellent. Excellent. All right. Lastly, after 25 years in executive leadership and PE, what do you believe matters now more than at the beginning of your career? What after at these couple decades are you like, this matters more? I realize this is more important now than I did when I was a young whippersnapper.
Yeah, it's a great question, and I would say, and this is probably something that won't surprise you, getting the people right is everything. When I was young coming up in this, it was always about, process and,
Making numbers work.
making numbers work,
Yeah.
all of it. You know what I mean? It was the product, it was, the customer, it was all those things that are super important, right? But none of it works unless you have the right people that can execute the plan. You hear that old, I think, Peter Drucker saying that, execution eats strategy for breakfast. Well, you know what? People execute, and that's where it all comes together. If you ask me, and I remember I'm a ex-GE guy, right, early in my career, and I was there when Jack Welch was still running the company, and he would say, that he spends 80% of his time on people. And at that time, being quite young and early in my career, I really didn't understand what that meant. I'm like, he's a chairman and CEO of, at the time, the world's most admired company,
Yeah.
and this whole thing. I'm like, what is it? It's customers and suppliers and all over the world, and manufacturing businesses and financial. Like, how can he? What does he talk about? Now I realize what he's talking about, right? I spend a lot of my time right now, and even as a board member with other companies, really assessing, do we have the right people in the right roles to deliver the plan? And are we honest about that? Right? And how many data points do we need truly to make a determination as to whether or not we have what we need? And to the extent that we don't, I'm very engaged and involved in the fix, right? The recruitment, the structure maybe going forward, moving some people around. I think that is really, really critical. And I think a lot of people don't spend enough time making sure that, not just when you hire someone, but as that person progresses, whether or not it's working. Because it goes back to something I said, you start to become comfortable, and in some cases, tolerant. And in business, tolerant isn't a good word, right?
All right.
And so it takes emotional intelligence, and I think honesty, to continually make determinations as to whether or not you have the talent you need across the board to execute the plan. And when that determination is made, that you don't, you've got to act swiftly.
Nice. He is Tyrone R. Johnson. The book, Beyond the Deal, CEO's Guide to Private Equity Success. Tyrone, thanks so much for the time. I really appreciate it.
Yeah, thanks for having me, Joe.
And that's going to do it for this episode. If you want to find out more information about Ty and our other amazing authors, go to theauthoritycompany.com.